Okay. Cool. So mortgage markets, we have more to discuss. We'll be quickly going through all the slides, but quickly on this is will be bonds are issued by Federal Reserve. Bonds are issued by corporations. That is for their own requirements to meet their objectives. That's the reason they raise the capital from the public in the debt form through bonds. But mortgage market is a bit completely different. When we say mortgage, it's all about the real estate, we can say. I think Lucas is missing today. So it's more about real estate and real assets. Loans are given against real assets. It could be residential, it could be commercial, it could be anything. So with that, let us move ahead. So today you'll be understanding what exactly are the characteristics of mortgage and how it differentiates other debt components we discussed. And interesting thing is the schedule, mortgage schedule. When you pay your monthly installments, you should ask for schedule so that you will be knowing what is the principal and interest component of that. Then different types of mortgages we'll see how it starts as a mortgage sale and how they are securitized with popular mortgage-backed securities or MBS. Then within that, what are pass-through securities, what are CMOs, we'll see, and we have more actually. And we also work on mortgage holders. And in the end, we'll see a little bit of trends in the global market about the mortgage markets. So throughout, once we finish the session, you should be able to identify, describe, differentiate, explain, or evaluate or analyze anything. If you got a problem, you can stop me anywhere and ask me so that I can help you. Okay, these are the major topics we have. Okay. So to start with, is the projector right? This is how we are seeing every time, or it is a little different?
I think normally you have the screen down.
I'm sorry, I'm wondering what I missed. Thank you. How it is different. Thank you. Okay. So a loan is taken from the bank with an asset as a collateral. That's what we call it as mortgage. And your question could be, does banks give loan without a collateral also? It may happen. Business people, they can get the loans against their future business, expected profits and so on. So, but we are not talking about all kinds of loans. Yes, it's a mortgage. So it is a collateral given to the bank so that you can get the loan. And there is no set size or denomination, means there is no minimum maximum. It can be a $10,000 loan to 10 millions loan. There is no standard denomination on that. Then the problem here is in the debt market and the bond market, we have seen in the last class, if you want to buy a bond, ratings are there. Okay, based on the ratings, investment grade ratings or non-investment grade ratings, you can say this is a good investment, non-risky investment, and this is a bad investment or in junk bonds or which are very risky, which have higher coupon rates. So but in this case, you don't have that kind of information. It means that the financial institutions or the banks have to shell out a lot of money to evaluate the borrowers. So here the institutions are the investors, right? So there's only one institution, one bank giving a loan to one person. It is one-on-one, no one else. Okay. Sometimes if a company borrows a huge loan, then 2 or 3 more banks can also pull together and give loan to one person. That's a rare case. But usually one institution giving loan to one borrower. That's how it goes. So the lenders or the institutions, they have to do a lot of homework on this. Then in this class, we'll be talking about mortgage market in 2 dimensions. One is primary market and the other one is secondary market. Quickly on these two, primary market, if you remember, we are talking about debt markets or equity markets. Primary market is first time the equity share is issued, first time the bond is issued, right? A new car is sold in the showroom. That is primary market. The secondary market is the same car is bought and sold again and again, used car market. Okay. Equity shares are getting traded in exchanges. Bonds are getting traded in exchanges, stock exchanges. That you call as secondary markets. Same thing happens here also. When we say primary mortgage market, it is the first time there is an agreement between the bank and the borrower to lend and borrow. That you call it as primary mortgage market. And in the secondary market, this is interesting for today's session, where these mortgages are pulled up. Many mortgages, many mortgage loans or mortgage asset-backed loans are pulled up and rolled as securities. That becomes secondary market. Okay? That's a primary difference between primary mortgage market and secondary mortgage market. Okay. Let us start with the primary mortgage market and know more about it. So I think how many of you have taken a loan, education loan, car loan, home loan, or any loan? 1, 2, 3, only 3, 4. Okay. I think you guys should help us whenever there is a point connecting to our discussions. It will be easy for all of us to understand better. And you will have a better idea to know about your own loan. So I think this is very interesting if you're having a loan. So in the mortgage types, we have non-recourse or recourse. So I say it could be other way also, recourse or non-recourse. Why I put non-recourse first is it's a normal way of taking a loan. You have taken a loan for your car, okay? For example, for some reason you couldn't pay the loan, right? Then the lender, the financial institution or the bank, they can claim only on the asset you have kept as the collateral. They cannot ask you more than that. Maybe you're rich, but you're not paying the car loan. So they cannot ask you, please liquidate your other assets and pay my loan. They cannot ask you that. That we call it as non-recourse loan. Clear? Then the other one is recourse loan, where the lender can go beyond your car. If the agreement is like that, which states it's a recourse loan, they can claim on other assets. The reason here is maybe it was a 5-year loan for the car, for example, 2 years got over and 3 years are left out, and the left out EMIs are not equated by the car resale value. They want to recover more from you. Okay. So if it is a recourse loan, I think you're in trouble. If it is a non-recourse loan, not a problem. That's the difference between a recourse and non-recourse loan. Then based on the markets within the primary market, you have, based on the assets, we can say, we have home mortgages. It is more of family homes, one single family, and we have varieties. And multifamily refers to communities which have condominiums, apartment complexes, townhouses, and so on. And you also have commercial mortgages, the shopping malls or complexes or retail outlets, they all come under this. And farm mortgages, when you take a loan to buy a piece of agricultural land to do some agricultural activities or farming or whatever. So out of all this, you can see this is the biggest market. Home mortgages is the biggest market, followed by commercial mortgage, 3.31 trillion. And the third is multifamily. Farm mortgage has very little stake in this, but still it is big asset. Number of borrowers are less. That's the difference. In some understanding of how this is placed from 1995 to 2021, I think it's almost the same. There's no much difference. It is dominated by family homes. I'm referring to this. Four family homes has the largest stake. Okay. So within home mortgages, I told you 1 to 4 families. So the data tells us that you have 1 to 4 family is dominating, followed by commercial. It is the same in 2021 too. Then mortgage characteristics, we will be understanding more about mortgage in these parameters. Mortgage rates, obviously, the interest rates, and that can be fixed rate or floating rate, either of these two. Mostly a fixed rate, but you need to check whether it is a fixed rate or floating rate. Then you have how the mortgage payments are done by you every month. It can be every week or every quarter or something like that, but usually it is every month. Okay. I hope you guys who are taking the loans, you have the monthly payments, if I'm not wrong. Okay. Then you have mortgage fee. That is a cost for you if you're borrowing, because institutions charge everything on you, on the borrower. Refinancing, we'll see what is that, then insurance, then amortization. We'll spend more time on amortization. So fixed rate mortgages we have, where if the loan is for 5 years or 10 years or 30 years or 20 years, whatever, it is fixed. No one is going to ask anything. Even the market rate is going up or down. The time you borrow, whatever the interest rate is agreed between you both, that will stay fixed for the life cycle of the loan. That's what you mean by fixed rate mortgages. Then adjustable rate mortgages, they are not fixed. Whenever the Fed rate increases, your mortgage rate increases, your loan rate increases, EMI or monthly installments increases. If the Fed rate is coming down, which is the benchmark, your payments, monthly payments will be coming down. So if it is a floating rate and you have a loan, you always love to see Fed rate announcing there is a rate cut because your monthly payments will be down. So again, when you get into a contract, basically there are 3 forms of payments that you may have. So one is obviously the down payment, the thumb rule or nominal practice in the mortgage market is that you pay 20% of cash. Okay. You say if you're buying 1 million worth of 100,000 worth of a house, 100,000 is too low, maybe 200,000 an apartment. If you 2-bedroom apartment, if you're buying that, maybe you have to pay 40,000 from your pocket. Okay, rest of the 160,000 you can take loan. So this 40,000 becomes your down payment. Then amortized, that 160,000 is amortized for the loan life cycle. Again, it is your choice. You want to have the loan for 10 years, 15 years, 20 years, 30 years. I think 30 years is the max. Okay. So banks love to have you take the loan for longer term because you'll be paying more interest for more term. So that's their earnings. Okay. But you, as a borrower, you should match your monthly payments to your income. So usually that's what we all do. right? So for example, if you are getting, say, some 15,000 as the salary per month, then we try to choose that it should be somewhere between 5,000 to 7,500 so that it will not hit my daily living, right? So accordingly, the payments will be amortized where you have a fixed payments for the whole life of the loan. Then some cases, balloon payment mortgages will be there where for the first 3 to 5 years, usually I'll show you the schedule and other things, but quickly on that, monthly payments, whenever you pay to the bank, it is a mix of the principal payment and interest. Okay. But if it is a balloon payment mortgage, which will the institute, I mean, the bank may demand you for 3 to 5 years to pay, which means for the first 3 to 5 years, you're paying the monthly installments, which is only the interest. Your principal amount stays like that only. It will not come down. So why does this happen? The reason is that there could be some reasons where the borrower may close the account, prepay the loan, right? Maybe he's rich or he wants to switch to some other bank, or she wants to, she got some problem with the lending bank and so on. So to avoid that, some banks they fix only interest. Okay. So the banks would be getting the whole of the advantage through interest. Their income will be earned for the first 3 to 5 years. Remember, it does not happen with all the loans. That tells you, my dear friend, this is a you have I have the option only to give you balloon payment mortgage. You don't get a normal amortized mortgage. So you need to check that. Then there are varieties of fee based on the loan you're taking, based on the size of the bank, to start with, processing charges are always there, a nominal application fee, title search, they will assess, review the property with legal experts in that area. Then title insurance, you have to get it insured. An appraisal fee, you have done the title search, but what is the worth of this asset? The banker or the lender should know, and you also should know about it. You want to take more loan, but what is its worth? Based on that only, the bank will give you the loan. Okay, I think if you go to Zillow, you'll get fantastic details on this. You can work more on this. It's a free open source. You can work on that. Then cost of or a loan origination fee, then closing agent fee if it is a foreclosure, then review fees. These are the varieties of charges or fees you will have, which you can call it as assortments of fee. So remember, all these are not there on all the loans, but these are the varieties where some or few are charged on your loan. You need to check for this. You have always a right to ask your banker, what is it? Can you reduce that? Can you waive for me? Okay. A rational borrower will work on all these details. Then you may also have discount points where the fees or payments made when a mortgage loan is issued while closing. So good is your debt record, you more are the debt points and discount points. I'm sorry. Then refinancing is one option where, by the way, have you heard about refinancing? You have taken a loan now, and I'm talking about refinancing. What this could refinancing be? Any guess? Could you see that? Can you tell me if you got it? Yeah.
Get a better interest rate.
As simple as that. You have taken a loan for say 8%. It's a fixed rate. If it's a floating or a changing interest rate, you don't refinance because you're getting adjusted to market. But it happens with fixed loans. You're taken a fixed loan for 8% and market is down. The market interest rates have come down to 7%. And you're paying 8%. You don't like it. No one likes that. You're paying more. So what you do is you try to close this and take another loan with the same bank or some other bank. It's up to you. Okay, that's how the idea of refinance comes into your mind. If the interest rates are up and up, you don't think about refinance. You will think about refinance only when the interest rates are coming down. Okay, thanks for that. Then insurance, this is something interesting. I think you need to check you have a loan, or if you're planning to take a loan. As we discussed, usually the down payment is 20%. 200,000 is the loan and 40,000 you're paying down payment. For example, you say, I can't pay 40,000, so no 20% down payment. I can pay you 10% down payment. In that case, there is something called private mortgage insurance, where it is required when the loan value ratio is more than 80%, which means loan value is 90% of the asset, not 80%. Okay, so borrower makes a down payment less than 20%. Usually they call it as either it is 80-20 or 80-10-10, which means 80 is the loan value, 10% is the PMI, and 10% is the down payment. That's the mix. And that's what you mean by PMI. And we have federal insured mortgages where the repayment is guaranteed by FHA and VA. Then you have conventional mortgages which are not federally insured. You have to pay from your pocket. So I think this is where you need to have a deep understanding. You may be working on some problems also. You need to be careful, as I had been always pleading you, use Excel for this. Okay. I think, give me a minute. Okay. So I was always talking about fixed monthly payments for your mortgage loan. Okay. 200,000 is the asset value. 20% is your down payment. Sorry, 20% is your down payment. 40,000 is your down payment in cash. And 160,000 is the loan taken from the bank. Okay. So for that, say if it is for 15 years, 15 years, how much you are supposed to pay? You all should know about that from this class. And those you're paying, recalculate your amortization also. We'll be learning that. So it is a kind of equal installments for your whole loan period. And each installment is a mix of interest as well as principal amount. But monthly installment is the same for the whole life cycle. So that is a very beautiful mechanism with the mathematical model. It was derived where initially in the monthly installment, interest component is high, principal is less. And in the last months, principal component is high, interest component is very less. We'll see that. Okay. Now, I think in our previous classes, we are talking about discounting and compounding, and we are talking about discounting. We discounted a single cash flow, multiple cash flows, and annuities also. If you have an annuity, you will discount that and find its present value. This we have already seen. But here our problem is different. We have a present value of a loan amount, and we have to find out the future annuities, which are our monthly payments. How do you do that? Okay. This is the simple formula you have. Okay. And in Excel also you can do it. Using the formula you can do it. I'm talking in the class. I'm talking about that in the class, in your exam, in your assignments, in your homeworks. You can use anything. Okay. Minor differences will be there. Any answer is the same. Maybe few cents it may go this way, that way, but either way it is okay. So in the order of preference, first one is Excel, second one is financial calculator. If you want to use normal calculator, use the formula, and you can also use present value table. The table will be provided to you in the examination point of view. If you want to use it right now, search for present value table, you'll get it anywhere. You can have your own copy. Okay. So how to do that? Let's see with an example. Can you all try this once? I want all of you to do it. It's a practice for your exam. If it is Excel or finance calculator or normal calculator, or you want to use by hand, it's up to you. Please, all of you do it. Try yourself. I'll help you and I will explain you the whole thing. I want you to try in your own way first so that I can come in with a helping hand. Could you do it? Could you try? Let me show you. Give me a moment. Okay. This is what I did for you all. You can do the same. I think I have the same example here also. Let me check. Yes, same example. So the question here is you took a loan of $3 million. Okay. And rate of interest is 12% per annum. So monthly it comes down to 1%. And the loan cycle is 55 months. Okay. So 5.5 years, 4.5 years. Then what is that I asked you? I asked you to find out what are your monthly payments, which are annuities for the coming 55 future months. So what I have the present value of annuity, which is 3 million. Okay. What is R? The discounting factor, which is 1%. Right. So R into 1 plus R to the power of N. N is 55 months. So same thing I put it in the denominator. Okay. So if you want to check this same with time value tables, you can do that. Simply present value factor at interest rate is 1% and N is 55. You will find the same. You can try that also. Okay. And if you want to do the same using Excel, it's very simple. I will share this file to you also, but follow this carefully. So this is the what I used. You can look at this. So what's the answer to the question? Is the question answered? How much is the monthly payment? 71,000, right? 178 and so on. Okay. Yeah.
Can you go back to the Excel file for a second?
Sure. I will be showing you all. So what we did here is your loan amount is 3 million at the 12%, which is 1% per month. And we got the answer as 71,000 plus. How did I get it? I got it using the formula. I got it using the finance calculator. I got it using the tables, and I got it using the Excel. So how did I do this? Formula is you type is equal to, for any kind of functions, mathematical functions, I hope you all are aware in Excel. It is, you have to use is equal to, then PMT. PMT stands for payments. Okay. Payments, it will, I think you can check that. You can try here also. When I say PMT, right? See, it is showing you very clearly. It is very user-friendly, Excel. It is asking for you to enter the rate. How much is the rate? 1%. Though I mentioned 12%, you are calculating the annuities per month. So cut it down to 1%. Okay. Say, for example, I give you in the exams or assignments or homework, the interest rate is say 7%. So per month, 7 by 12. Per annum, 5%. Divided by 12, it becomes 2 per month. Okay. So enter the rate, then number of periods, that is number of months, in our example 55, and present value. Present value is the loan amount. 3 million is the loan amount. There is no future value, and type is, you have to put 0, 0. You follow the same format. I want all of you to try this. Tell me whether you got the answer or not. All of you, please try this. Yeah. Negative? Yeah, thanks for letting me know that. Very good point. I want all of you to try. It will be very easy in the exam because I will enable the Excel file to be used in your exam. You don't have a problem at all. You can put all your personal financials into this also, not just for the class or the grades. It's a personal accumulation. So could you all get it? Is there any problem? Let me know. So again, I'm repeating, just put is equal to PMT, enters the interest rates, number of months. Here we have 55, followed by present value, the loan amount. Rest of them are 0 or 0. Sometimes you may get error. Just follow this format. Okay. To check what I used, I did the same. You can see this. You can directly enter the values, or else if you have the values in a reference cell, you can refer to that cell. That's what I did here. Okay. And here my formula is, my R is B3 by 12, which means I put it as 12% here. That divided by 12 is R there. Then in the next NPER, it is B4. Number of periods, it is 55. Then B2 is the present value, which is the 3 million. So here in Excel calculation, as our friend was asking, why negative? In finance calculator or Excel, in present values, we use present values with a minus or negative symbol. So once you put, you can see this here, when I've taken the home loan, I put it as a negative value. In your answer, it will be positive. Okay, that's a difference. Is it clear to you all? We just calculated monthly installments. If you have taken a loan for your own loan, please do the same calculation. Any bank across the world will use the same formula. Okay. So if that is fine, let us go ahead. I hope you all are clear on this. If you have a question, you can ask me. Yeah. Then now the other way is you want to know, okay, I got my monthly installments paid, but now I want to know what is the mix of interest rate and principal? Okay, in each month of my payments from first month to 55 month. Okay, why it is prepared? Why you want to know that? Well, let me show the schedule first. How a schedule is prepared? This is how I prepared the schedule for you. Even you can prepare your own schedule. Have a look into it. So what I did, one column for number of months. Okay, number of months. Then you have payments. I can't write here. Payments here. Then I calculated payment is your monthly installment, which I did it here. It's the same for all the months. Number of months will be changing. 1, 2. I had, this is a loan for 55 months. Yeah, I got 55 months. So monthly payments are the same for all the 55 months. Then I want to know what is the mix of interest and principal in my total payment. That's what I wanted to know. Okay. So say you take first installment, 71,179, 12 cents is my first installment, out of which 30,000 is your interest component and 41,179, 12 cents, dollars, 12 cents is your principal component. Okay, that much amount is deducted. And interesting thing is how much is the interest in the first year, first month, sorry, $30,000. If you can observe how much is the interest rate per month, 1%. How much is your loan value? 3 million. So 1% of 3 million is 30,000 is the interest. Because outstanding loan before you start payment is 3 million. Then for the second month, okay, your outstanding loan becomes, it's not 3 million, it is 2,958,820. For the next month, your interest will be charged on this amount, which is this. That's the beauty of your equated monthly installments or monthly payments. So I'm just explaining you the mechanics of this, but why you want to know about this schedule? First, if you see, interest rate is high, 30,000, and further it is decreasing. Okay, and principal amount, which is 41,000, it is increasing. Level of deduction is increasing. And in the outstanding loan value or the balance, it is decreasing. So for example, midway after 15 months or 20 months, you wanted to know how much interest I am paying so that I can get the tax advantage. I can claim to my federal taxes. How much interest amount I can claim. I want to know that. Then you can prepare the schedule. This is what you call it as a schedule. Okay. So amortization and schedule related to your mortgage loan. Is that clear to you all? If yes, I'll go ahead, else you can ask me a question if you have. So the same thing I'm showing you here for same 55 months example. You take any month, any kind of loan, any interest rates, you'll get the same answer using the Excel. To remind you, you can also use ordinary calculator or finance calculator, or you can calculate manually also. You get the same answer. So this is what I'm trying to say. Initially, it is high interest rates. Say, for example, in the first month, your interest rate is 30,000. Okay. And when you reached 50th month, for example, interest payment is only 5,000. And in the last month, interest rate is low, principal is high. Interest rate, I'm sorry. Yeah, I'm right. You can see here. Interest is 4,000, but principal amount is 67,000. Maybe someone wants, no, it is not looking good. I want my, whatever I pay, I want more to be deducted. You take your interest, but I want more to be deducted from the principal amount. That option also banks can give you if at all you ask them. Why? Because more is the diminishing rate of your principal, less is the interest rate you have to pay. Okay. And some more varieties of mortgages. You have jumbo mortgages, you have subprime mortgages, you have second mortgages, and you have reverse annuities. Quickly on that, let's see. So jumbo mortgages or jumbo loans are the loans which exceeds the basic norms set by government agencies, which we'll discuss about them in the mortgage-backed securities. So I think I just updated. You can cross-check and let me know if I'm right or wrong. For 2026, the baseline is 832,000 when you say maximum limit for a normal type of loan. But in high cost areas like big cities like LA or New York or some kind of cities, it can go up to 1.2 million, the minimum loan. If it is beyond that, it is a jumbo loan. That's our discussion here. And there are some special areas listed, and it is the same again. It could be 1.5, even 1.8 also, high cost ceilings. So what do you mean by this? They have more risk. The loan size is bigger. The issuer or the bank or the lender is taking more risk. That's what you mean by jumbo loans. They're not protected by federal agencies or federal sponsored enterprises like FENIMA, Freddie Mac, Genima. Subprime mortgages, I think this is the whole thing which caused the 2008 recession or crisis. Okay, there was heavy lending to submortgages because of securitization. So because these are the people who have very less credibility, they have high risk, but huge potential for default risk. In that case, you call them as subprime mortgages. The reason could be of bankruptcy or charge-offs or judgments against them, and they have a weak credit history seen through payment delinquencies with severe problems. This is again interesting here. When you take a loan, it's a plain loan. One more variety of this is when you take a loan, you have paid 50% of the loan. Okay. So when you pay 50% of the loan, so you're eligible to take that worth of value again from the bank that you called as equity. And again, you may not take a loan, but you may have a short-term credit, which is known as home equity line of credit. Then one more interesting is piggy bank mortgage, additional loan to compensate your payment. That if you remember, 80-20 is the normal one. But if you're saying I can't pay 20, then the piggy bank mortgage may come into the picture. So what happens here is for that additional 10%, they will derive a separate loan. As the risk is high, interest rate will be high on that. And there is something called payment mortgage interest insurance, where the cost is there. This will happen if you have the PGM interest cost of piggy bank mortgage less than the PMA cost. If not, you can go to insurance, where you can get 90% loanable value. I think this is for retired people or old people where they have an asset, okay, where the banks will be paying the annuities. So the landlord, the homeowner need not pay anything. They don't have the earnings and they don't have anyone to, there are no successors for their properties or so on. So what they do is they hold the property, they live in that property, and they keep on getting the monthly payments till they survive. Once they pass away, banks will take the possession of the property. That you called as reverse mortgages or reverse annuity mortgages or RAMs. That's a whole thing about primary market. Now let us get into secondary mortgage market. Some of them are little repetitive, but let us quickly go through them. So it happened in 1940s, 30s and 40s, where securitization started with the Federal Reserve intervention to boost the lending activity in the economy, where the bankers can reduce their liquidity risk, interest rate risk, and credit risk. So they generate free income, helping to offset the effects of regulatory constraints. If at all they see that problem is in the borrower's point of view. So they are the kind of packages which are sold backed by the respective assets. So initially, FINIMA is in the history to be known first attached with the securitization of mortgage markets, followed by Genema and Freddie Mac. These are the three institutions even now which operate actively to promote home loan or mortgage markets, home loan or commercial loans also. We have been talking about that in many sessions. We are talking a little bit more about them. So it happens in such a way that usually this may also happen. Remember, when we have assets pooling, it's not with one bank. These are the assets of many banks. One bank has many assets. Not only that, many banks may pool together and roll out it as a security. So it can be with or without recourse. And it happens when the banks originate a mortgage and sells it to an outside buyer. So who buys it when the loans are pooled? FINIMA or Freddie Mac, they will be buying this and offering to the public as the securities or the bonds. Bond market we have seen. So FINIMA or Freddie Mac will be actively doing this. So they're like taking the whole assets and risk from the bank and converting them into securities, offering them to public, giving that to banks. That's a simple process to understand. So here we have little varieties within the securities, pass-through securities, CMOs, and mortgage-backed bonds. We will quickly see that. We also have asset-backed securities in this securitized markets, where we have been talking. Our discussion is only limited to mortgages, but in the securitization, we also have other assets where companies will be selling their fixed assets or working capital as assets into securities for their short-term capital requirements. Then we have to start with MBS, mortgage-backed securities, only with the home loans. We have pass-through certificates, CMOs, where CMOs are kind of tranches based on risk and maturity to avoid prepayment risk. So they all are not pulled up together. There is a difference between a 10-year loan and 20-year loan and 30-year loan. So they will be selling these securities as tranches where all 10 years are pulled into one, 15, 20, and so on. A 10 years loan compared to 30 years loan, which one is risky according to you? A 10 years loan, a 30 years loan, both are offered to you. Which one is risky? We're talking about risk only, not returns. 30. You're right. So longer the tenure, higher the risk. Shorter the tenure, lower the risk. Okay. Similarly, based on the borrower's risk also, the pooled mortgages are separated into tranches: high risk, medium risk, low risk. Then again, you also have separation of interest and principal. which we called as SMBS, stripped MBS or stripped mortgage-backed securities, where principal and interest rates are sold separately. So it's all about if you want to buy only the interest rate or if you want to buy only the principal. High risk loans will have a discounted value of the principal amount. That's the reason principal is separated. If you feel, no, I don't want principal, as till the time I get the interest, I'm happy with that. You may buy only for the interest. They are also separated into tranches. Then you also have real estate mortgage investment conduits, where Remix, more popular as, issued as CMOs. So all these things happen in OTC market. They are not into stock exchanges. Please don't get confused when we talk about the trades. It's a repetition. Sorry for that. It's a repetition again. We discussed these three. The history of that. Apart from FINIMA, Freddie Mac, and Genema, we also have the securitization done by non-agency, which are again banks or financial institutions. They're not guaranteed or they're not the same as the sponsored agencies guaranteed loans. They don't confirm government-related issue standards. So some idea on what's happening from 90s to 2021. It is about pass-through securities. Pass-through securities means the whole security is given as it is. It includes principal and interest component. Other things are principal and interest are separated based on the borrowers. There are tranches and so on. Okay, so if you look at pass-through certificates, pass-through securities, the total amount in 2021 was 3.4 trillion, which was 2 trillion. And in the meantime, it was highest. You can see here, the peak level is close to 7.5 trillion. Okay. So after that subprime mortgage crisis, MBS securities, everyone thought it is dead. I think it will not survive, but you can see it continued 3, almost around 3 all the years. So I think a bit of repetitions here. There is something called MBBs, mortgage-backed bonds. They are not, it's not part of securitization, but I gave you when FHLB issues bonds against the assets it has. Then mortgages outstanding by type of holder, who invests more into it? Financial institutions and mortgage pools. They share 90% of it, and it's the same. It's not the same. Mortgage pool has come down to 13 or 14%, which was 40% here. Financial institutions had 49% here, and it has come down to 37. Federal and related agencies has increased to 40%, which was nothing here, little here, but it increased more here. That's the difference. So again, a trend here from 1986 to 2020. Again, we always refer to 2008. I thought it will come down, but there is a little fall here, but it went up. It is all-time high actually. This is with auto asset-backed securities, where many non-real estate securitization happens. This is a trend of that. Again, here also it was in the peak in 2008, fell off, and it's not like MBS, but still it is good. Then when you look at the total fixed income market, including the bonds and debts, this is the picture we have. I think unfortunately we don't have the pictures here. The total is treasury, number 1, followed by mortgage. This is 2. Am I right? Yeah. Treasury debt is 23,000, and this is 12,000, followed by corporate debt. This is 3. All debt markets put together, if someone is asking which one is bigger, obviously treasury, followed by mortgage markets, securitization, followed by corporate bonds. This is as on 2022. We need to check for new numbers. And in the international scenario, I think US is the leader. No one is closer to it, but some of the European countries have this securitization market in UK, Germany, and so on. They're popular. They're following the trends along with the US. And we also have some synthetic securitization like credit default swaps, total return swaps, and credit linked notes, where it's a kind of derivative. You have seen equity derivatives, bond derivatives, but we also have credit derivatives like credit default swaps. It happened again with Lehman Brothers. It is about insurance companies. Insurance companies, they issue credit default swaps. I forgot the insurance company name. They covered a huge risk of Lehman Brothers. Okay. Oh, in credit default swap, what happens? If the company defaults, the insurance company which covered the credit default risk will pay the whole to the persons related to that. So it happened with Lehman Brothers. And I think it happened with the Greece government in Europe. It was huge. They also had credit default swaps and they defaulted, and the insurance company has to pay the whole amount. So related to credit risk, there are some other options we also have. You can check on that more if you're interested. So globally, 2002 to 21, I think the US is too big. No one is closer to it. Okay. So now you have the whole list of things. Now I want you to go through it quickly. I have a small activity. Go to your discussions page in the modules, or you can go to discussions directly. Click there. Please discuss first. Discuss with your friends who are sitting next to you. And I want you to have a complete understanding so that you can differentiate. That is my idea. Okay. See, I want you to know about all these things. And at the end, I want you to know about all these things as a summary. Okay. So go through the module section in the discussion. I want you to, before you answer your choice of instrument and so on, I want you to spend a bit of time in understanding that security with discussions. Please discuss with others. I don't want you to form the groups. It may take some time. If you want me to form the groups, what do you say? I don't see any discussions here. Yeah.
The discussion.
Yeah. It's not available. Let me see. You want to form the groups or you want to discuss for yourself? Yeah. I don't see the discussions. That's the reason I'm asking you. Yeah, I'm just working on that. Our friend was asking about that. Hmm. I'll make it available to you. Just start your discussions on that. Why you hate, why you like. Before that, maybe this is a quick summary of that. What happened to this?
Yeah. Yeah.
I like them. One of these that are used for, this one, create. This is a low risk. When I have my financial. Just very. Yeah. So there's who. Yeah, so you have to do something more against. Yeah, I agree. A lot less like it's sort of like.
Yeah, right. No, it's like.
Check once it is available. Is there?
No.
Huh? Just refresh and try. I don't know what's happening. Check now.
No. And I think auto.
Yeah, I think so.
I can see the discussion now. Thank you.
Yeah.
Oh, was there a discussion on the other side? Was there a discussion during the?
No, this is the same I was referring to.
And the exams. Or next Tuesday? Next Tuesday? 17th?
Yes.
I have a question about mortgage-backed securities, like principal only ones. Do you ever pay interest on that?
No,
It's only. principal.
yeah. The thing is, it is split into tranches, only principal, only interest. Why it seems foolish, right? Why are you buying only principal? There is no appreciation or depreciation on that. It would happen that it is a very risky asset. And say it is 100 rupees is the face value, say, but it is trading only for say $50 or $60. If it is getting paid as the actual borrower pays the principal, you get the money. Make sense?
So if I have a principal completion, yeah. Do I own the house? Do I own the house?
No, you don't own anything. It is like the same loan stays as it is. Okay, but the financial institution of the bank has transferred the risk or something else to the sponsored agencies.
Kind of for the.
No, the bank is out completely. The bank is completely out of the picture. They don't have any risk, but the borrower is there. Then who becomes the holder? If you are buying that, it is you.
Okay. So then you would be paying the principal, but if they pay, you just.
If I'm the borrower, I'll be paying the principal,
On the strip.
and you will be getting on the strip.
And if I have the strip, do I also pay the principal?
You know,
You're paying.
you're an investor.
So what-
I repeat
what's the
again.
investor
I
doing?
repeat again. I took $100 loan from a bank. Okay, bank converted it as a security, right? You bought that. $100 is the security, and I also supposed to pay say 8% as the interest. So when you talk about stripped securities, this interest and principal are separated. Why? Because interest everyone knows. But the problem is you got up if he is buying only interest only, he is worried about my default risk, and he buys my security because only he's worried only about interest payments. Till the time, as long as I'm paying interest, he will is happy. You are buying only my principal. You are not worried about interest, but you want to take huge risk because I have high risk.
Yeah.
And this $100 worth is getting traded only for say $50, $60. If I'm a prompt payer of that, you get money. That's how you make money of these tranches. Make sense?
I know we're gonna go into more detail on Thursday, but just for today's launch and today I hope you're studying, what would you recommend on the core concepts to? Like everything?
No, I'm telling you again, there's nothing like important or there's nothing tough here.
Okay.
Everything is easy when you look at this as an understanding.
Yeah.
If you try to memorize or mug up, nothing works.
There's a lot of math.
I'll talk about everything. Don't worry. First of all, don't break your heads for